Wall Street wasn't always about stocks, skyscrapers, and fast trades. Long before the suits and the trading algorithms, it was something darker. Buried beneath New York's financial success is a story that rarely gets told. A backstory of forced labor, human lives treated as capital, and profits rooted in bondage. We're not here to retell what you already know about slavery. We're here to look at what got left out. The parts that didn't make it into the polished stories of American success. The buildings still stand, some of the names are still in business, and the wealth created during that time didn't disappear. It compounded. The truth is buried in plain sight. And now, it's time to dig it up. Give this video a like to show your support, and let's explore the history they tried to keep from us all these years. How Wall Street was built on slavery. It's hard to imagine now, with banks and office buildings lining the streets of Manhattan's financial district. But in the early 1700s, the corner of Wall and Pearl was also a site where thousands of enslaved people were bought and sold. Right there, where office towers now loom, the city of New York operated a municipal slave market. It opened in 1711 by order of the city's Common Council and remained active until at least 1762. The city government authorized, funded, and maintained the market. A wooden structure was built to manage what had already become a busy trade. Before this, selling of slaves took place in various parts of the city, including the docks and private homes. The council claimed the market would help control traffic and limit disruption to commercial activity. It also established slavery as a formal part of city operations. The market was built at public expense and placed near the East River Ferry Landing. This location was chosen to connect newly arrived enslaved Africans directly to New York's economy. The Common Council required that all sales go through the new market, and the city collected fees on each transaction. Enslaved people became part of the same revenue system as goods and property. By 1703, more than 42% of households in New York held enslaved people, and by 1746, nearly 20% of the city's total population was enslaved. The market's location near the waterfront made it easier to bring people off ships and into the labor force. Those sold there worked in shipyards, warehouses, homes, and on construction crews that shaped the early city. The transactions were public. Men, women, and children were sold openly. Prices were based on age, health, and perceived ability to work. Auctions were announced in local newspapers. Sales were recorded in official ledgers and wills, an organized system managed and documented by city authorities. This is where the story begins. Not hidden, not secret. Right in the middle of the street. Some of New York's earliest wealth came from this period. Merchants who dealt in goods tied to the Atlantic slave trade used enslaved labor locally and abroad. Profits supported banks, insurance firms, shipping companies, and land purchases. These institutions got richer and richer, with money made through slavery. As the United States grew, so did the economy built on enslaved labor. The invention of the cotton gin in 1793 by Eli Whitney made it easier to separate cotton fibers from seeds, and that single advancement turned cotton into a dominant cash crop. It also locked slavery even deeper into the country's financial systems. By 1860, the U.S. was producing over 4 million bales of cotton annually, and nearly all of it was picked by enslaved people across the South. But the impact of that cotton didn't stop at southern plantations. It rippled outward, directly fueling the industrial and financial expansion of the North. New York, in particular, was at the center of it all. Northern banks provided loans to plantation owners, insured slave ships, and underwrote the purchase of land and labor. Brokers in Manhattan bought and sold Southern cotton, and Wall Street firms arranged the export deals. Cotton became part of global trade, and institutions in the North were involved in keeping it in circulation. The reach of cotton money was vast. Nearly every major financial institution in New York during the 1800s was connected in some way to the cotton trade. The New York Marine Insurance Company, for example, routinely insured ships carrying cotton and enslaved people. The city's merchants built warehouses and docks specifically for cotton exports, and some of the most prominent Wall Street firms of the era either handled Southern cotton or loaned money to those who did. Despite being in a state that had abolished slavery by 1827, New York City earned a reputation as the capital of the South because of its economic entanglement with slavery. Southern planters and northern bankers were part of the same system, separated by geography but united by profit. Cotton profits passed through northern hands long before reaching British textile mills or European markets. And this wasn't just economic convenience, it was policy and infrastructure. The federal government helped build the cotton empire by supporting slaveholder interests, enforcing fugitive slave laws, and securing trade routes. Meanwhile, American newspapers printed cotton prices alongside stock quotes, and enslaved people were often used as collateral in bank loans. The value of the cotton economy, driven by enslaved labor, was so massive that it made up over half of all U.S. exports by the eve of the Civil War. Cotton was produced in fields, but its influence reached into ports, financial institutions, and business records. The money taken from enslaved labor extended beyond the South and into other parts of the economy. It was embedded in the very structures of northern finance and development, and New York, with its banks, insurers, and shipping empires, sat right at the heart of it. Slavery extended beyond forced labor. Enslaved people were forced to work, but they were also mortgaged, insured, and recorded as assets in business records. In Louisiana, Citizens Bank used more than 13,000 enslaved people as collateral for loans during the 1830s and 1840s. Each person was assigned a value, written into contracts and counted toward the bank's total capital. If loans were not repaid, the bank had the legal authority to claim ownership of those individuals. Several banks that existed during this period later became part of firms still known today. J.P. Morgan Chase publicly acknowledged that two of its predecessor banks, Citizens Bank and Canal Bank in Louisiana, accepted enslaved people as loan collateral and took ownership of more than 1,200 individuals when debts were not repaid. The use of enslaved people in insurance was also widespread. Companies such as New York Life and Aetna sold life insurance policies for enslaved individuals during the 1840s and 1850s. These policies were purchased by slaveholders, and payouts were made to them if the insured person died. Some of the insured were hired out to dangerous labor, including steamboat work and mining, where the risk of death was higher. This system was recorded in official business documents. Enslaved people were listed with monetary values and treated as part of a company's financial portfolio. Some were insured more than once, and these policies were bought and sold as part of broader financial activity. Financial records treated loss of life as a matter of compensation. These decisions, often made in offices and boardrooms, reduced people to entries in a column or calculations in a ledger. The profits from slavery helped launch, expand, or sustain some of the most familiar names in American finance and commerce. Fleet Boston, for example, traces its lineage to Providence Bank. Founded in 1791 by John Brown, a Rhode Island merchant and slave trader who was also one of the first Americans tried in federal court for violating laws against the international slave trade. The bank that began with his profits eventually became part of Fleet Boston, which later merged with Bank of America. Lehman Brothers began in Montgomery, Alabama in the 1840s when Henry Lehman opened a dry goods store. His brothers joined later, and the business quickly expanded into cotton brokerage. The cotton they traded was picked by enslaved people, and their profits helped finance the firm's rise on Wall Street. For decades, the cotton trade was central to their business model, long before they became a major investment bank. Brown Brothers Harriman, one of the oldest private banks in the U.S., also profited directly from slavery. The firm's founders, including James and William Brown, were involved in financing the slave trade and owned hundreds of enslaved people through their business operations in the 19th century. They issued loans to slave owners, arranged cargo shipments, and insured human cargo across the Atlantic. Aetna, based in Connecticut, sold life insurance policies on enslaved people and admitted in 2000 that it had issued such policies in the 1850s. New York Life also sold similar policies, and many of its early profits came from this practice. Brooks Brothers, now a high-end clothing brand, got its start in the early 1800s outfitting enslaved people in the South. They sold coarse, inexpensive clothing in bulk, what was often called slave cloth, to plantation owners looking to dress the laborers they owned. These practices were not minor parts of business activity. These were core business operations that helped lay the groundwork for corporate expansion. Profits earned through the exploitation of human lives were reinvested, compounded, and used to build institutions that now present themselves as symbols of stability and success. And that legacy didn't stay confined to ledgers and bank accounts. Railroads, canals, and factories in the US didn't just pop up out of nowhere. They were built literally by enslaved hands and funded with profits extracted from their labor. In the South, enslaved people were used to construct the physical backbone of the economy. They cleared land, dug canals, laid tracks, and built levees. The New Orleans Canal, for example, was excavated in the 1830s almost entirely by enslaved workers in brutal, deadly conditions. Railroads like the Virginia Central and the South Carolina Canal and Railroad Company used enslaved labor extensively. And mind you, these weren't side jobs. They were massive undertakings that helped fuel regional growth and connect cotton-rich areas to ports and shipping centers. In the North, where slavery had been legally abolished by the early 19th century, the influence didn't disappear. It just changed form. Northern foundries manufactured hoes, cotton gins, and chains for plantations. Toolmakers and blacksmiths filled steady orders from the South. Shipbuilders in places like Boston and Providence constructed vessels used to transport slave-picked goods like cotton, tobacco, and sugar. These ships didn't carry enslaved people directly after the transatlantic trade was banned, but they carried the economy that slavery made possible. The textile mills of New England, especially in Lowell, Massachusetts, were some of the clearest examples of how slavery's reach crossed state lines. These mills ran on Southern cotton, and they ran constantly. The booming factory towns they powered helped drive America's industrial rise. Behind every bolt of finished fabric was raw cotton, picked by enslaved people hundreds of miles away. Northern investors also had a direct influence. The profits earned from cotton brokerage, slave-backed loans, and shipping were reinvested into urban infrastructure: banks, rail lines, streetcar systems, and public buildings. In cities like New York, Boston, and Philadelphia, capital generated through slavery quietly flowed into construction and development, laying the foundations for growth that still defines those places today. Even the bricks tell a story. In states like Virginia and the Carolinas, enslaved people worked in brickyards, producing the literal building blocks used in homes, walls, factories, and rail stations. Some of those buildings still stand. Others were torn down or repurposed. But the labor that built them hasn't been forgotten, at least not by history. In short, slavery was integrated into the development of the whole country itself. It supported both physical construction and economic growth. Buildings, transportation networks, and industrial centers expanded through systems that included enslaved labor and the capital it generated. It's only in the past few decades that some of the institutions built on slavery's profits have started to publicly acknowledge that history. What had long been buried under corporate silence and polished branding is now beginning to surface, piece by piece. Companies like J.P. Morgan Chase have issued formal apologies after internal reviews uncovered direct ties to slavery. In 2005, the bank admitted that 2 of its predecessor institutions had accepted enslaved people as collateral and, in some cases, taken ownership when debts weren't repaid. As part of that acknowledgement, J.P. Morgan established a $5 million scholarship fund for African American students, a gesture that marked a start, though not a settlement. Insurance companies have followed suit. Aetna issued an apology in 2000, recognizing that it once viewed human lives through the lens of risk management and profit. New York Life also acknowledged its role and confirmed it had sold similar policies in the mid-19th century. Colleges and universities have been pushed into their own reckoning. Georgetown University in 2016 publicly admitted it had sold 272 enslaved people in 1838 to cover its debts. The sale kept the school financially afloat. As part of its response, the university offered descendants of those individuals a form of legacy admission and created programs focused on reconciliation, though some criticized the steps as symbolic without broader material support. At the city level, local governments have started demanding transparency. In 2002, Chicago passed an ordinance requiring companies doing business with the city to disclose any historical ties to slavery. This law pushed corporations to examine and reveal information that had been sitting in archives and board minutes for generations. Other cities and states have since followed with similar initiatives, spurring a wider public conversation about how the legacy of slavery lives on in modern institutions. Markers and memorials are slowly appearing. In 2015, New York City finally installed a plaque to acknowledge the former slave market at Wall and Pearl Streets. It's small, easy to miss in the blur of downtown, but it marks a shift. For decades, there was no sign that anything had ever happened there. Now, at least, there is a name, a place, and a story being told. And alongside these recognitions, the conversation around reparations is growing louder. Advocates argue that symbolic gestures are not enough, that if wealth was built through bondage, repair must go beyond plaques and apologies. Discussions now include financial compensation, investment in Black communities, and a deeper accounting of who benefited and who paid the cost. This moment isn't a conclusion, but an opening. The institutions that profited from slavery didn't vanish. They grew, adapted, and became pillars of modern life. And now, as history re-emerges into public view, there's a choice to be made, whether to simply acknowledge the past or to change the systems still shaped by it. The past didn't vanish when slavery ended. Its effects didn't disappear with emancipation, Reconstruction, or civil rights legislation. The consequences remain in wealth, opportunity, and policy. Black families in America continue to face the outcomes of stolen labor, broken promises, and blocked access to the wealth they helped create. As Wall Street became a global financial center, the people whose labor supported its rise were kept out of the prosperity that followed. Enslaved individuals were never paid, and that absence of earnings carried through generations. By the 2020s, the median white household held nearly 10 times the wealth of the median Black household. This disparity grew through housing discrimination, unequal education, employment restrictions, and barriers to property ownership. After emancipation, there was no compensation, and economic programs often remained out of reach. Meanwhile, institutions built on slavery's profits expanded and passed on their gains. These outcomes were the result of decisions made through policy. Programs like the New Deal's housing efforts and the GY Bill often excluded Black Americans, even as they supported broader economic growth. Banks denied loans through redlining, and insurance companies imposed higher rates or refused coverage. At many levels, systems meant to build wealth remained closed off. So when we talk about the legacy of slavery, it's not just about looking back. Really, it's about understanding how the past lives in the present. It's about recognizing that the wealth gaps we see today didn't start with bad choices or lack of effort. They started with stolen time, stolen bodies, and stolen futures. We can't rewrite what happened, but we can stop pretending it didn't. This history isn't over. It's written into policies, passed down through property lines, and felt in every conversation about equity and reparations. The legacy of slavery still echoes, and until it's faced with honesty, the gap it created will keep echoing too. Thank you for watching. If you found value in this video, share it with someone who needs to hear it. History doesn't stay in the past. It lives in the systems we move through every day. And the more we understand where those systems came from, the more we can question who they're really built for. Subscribe to Black Journals for more honest takes on global power, hidden histories, and the forces shaping the world around us. Until next time, stay curious, stay sharp, and don't stop asking the hard questions. See you next time.